Investing in the stock market can seem intimidating at first. With news of soaring profits and dramatic losses, it's easy to feel overwhelmed, especially if you're just starting out. But the truth is, making money in the stock market isn't reserved for financial experts or seasoned traders. Everyday people, from students to retirees, can and do build wealth through smart investing. So let's break down exactly how beginners actually make money in the stock market, step by step. First, let's understand what the stock market is. At its core, the stock market is a marketplace where people buy and sell shares of companies. Owning a share means you own a tiny piece of that company. When a company does well, the value of its shares can go up. When it struggles, the value can go down. But there's more to it than just buying low and selling high. There are two primary ways people make money through stocks: capital gains and dividends. Capital gains are the profits you make when you sell a stock for more than you paid for it. For example, if you buy a share for $10 and later sell it for $15, your capital gain is $5. Dividends, on the other hand, are payments some companies make to shareholders, usually from their profits. If you own shares in a company that pays dividends, you'll receive regular payments. Think of it like a reward for being a part owner. So, how do beginners get started? The journey usually begins with opening a brokerage account. This is like opening a bank account, but for buying and selling investments. Many platforms today are user-friendly and designed for first-timers, offering educational resources and low fees. Once your account is set up, you can deposit money and begin exploring the world of stocks. But before you start buying, it's important to have a plan. Successful investors know their goals. Are you saving for retirement, a house, or perhaps your child's education? Your goal will help determine your strategy and how much risk you're willing to take. The stock market can be unpredictable in the short term, but over the long run, it has historically gone up. Patience and a long-term mindset are key. Next, beginners often start with blue-chip stocks or index funds. Blue-chip stocks are shares in large, well-established companies known for stability and regular dividends. Think companies like Apple, Microsoft, or Coca-Cola. Index funds, on the other hand, are collections of many stocks bundled together. When you invest in an index fund, you're spreading your money across dozens or even hundreds of companies. This diversification helps reduce risk, since you're less exposed to the ups and downs of any single company. Let's talk about risk. Every investment comes with some risk, the possibility that you could lose money. But not all risks are equal. By diversifying or spreading your investments across different industries and companies, you can protect yourself from big losses. Many beginners make the mistake of putting all their money into one hot stock, hoping for a quick win. While it's tempting, this approach is risky. Instead, most successful beginners invest regularly and avoid trying to time the market. This brings us to the power of dollar-cost averaging. This strategy involves investing a fixed amount of money at regular intervals, say $100 every month, no matter what the stock market is doing. Over time, this helps you buy more shares when prices are low and fewer when prices are high, which can lower your overall cost per share. It's a simple, hands-off way to grow your investment steadily. Now, let's address a common myth. You don't need a lot of money to start investing. Many platforms allow you to buy fractional shares, meaning you can invest with as little as a few dollars. The key is consistency. Even small, regular investments can add up over time thanks to the power of compound growth. When you earn dividends or see your stocks increase in value, that money can be reinvested, leading to even more growth. It's like a snowball effect. The longer you stay invested, the more your money can grow. But what about making mistakes? Every investor, beginner or expert, makes them at some point. The important thing is to learn from them and not panic. The stock market will have ups and downs, and it's normal to see your investments fluctuate in value. Instead of reacting emotionally, focus on your long-term plan and avoid the temptation to buy and sell based on headlines or short-term changes. Education is your best friend. Take advantage of free resources, books, podcasts, and courses. Many brokerage platforms offer tools and tutorials designed for beginners. The more you learn, the more confident you'll feel about your decisions. It's also a good idea to start small and grow your investments as you gain experience. You don't have to be an expert to get started, but building a habit of regular investing and learning as you go can set you up for success. Over time, you'll get a feel for how the market works and what kinds of investments fit your risk tolerance and goals. Another tip for beginners: avoid high fees. Some investment products, like certain mutual funds or managed accounts, come with high management fees that can eat into your returns over time. Look for low-cost options, such as index funds or exchange-traded funds, ETFs, which typically have lower fees and still offer broad exposure to the market. Finally, remember that building wealth in the stock market is a marathon, not a sprint. Most successful investors don't get rich overnight. They build wealth slowly, with patience and discipline, by sticking to their plan, reinvesting earnings, and weathering the inevitable ups and downs. In summary, beginners make money in the stock market by understanding the basics, setting clear goals, starting small, diversifying their investments, and staying disciplined. With time, patience, and a commitment to learning, anyone can tap into the power of the stock market to build lasting wealth. Start your journey today, and let your money work for you.